Yeah. Okay, fantastic. Without further ado, let's start this session. We have Paul and Jonathan to present on the U.S. macro and sector outlook, as well as stock picks, followed by Jay Tun to talk about technical analysis in trading strategy. Let's give them a round of applause. Thanks.
Good morning, everyone. So thanks again for joining us today. So today I'll be talking about US macro. I'm just the extra. The main event is, of course, Jonathan, who's our US equity research. He's heading the team, so he's going to just share with you some of his top picks. We focus a lot on the US, namely on the tech names. So hopefully nobody asks us about banks, but maybe later on we'll probably expand the coverage. So we're just going to run through how we see the macro conditions in the US. I guess it's particularly important since they had such a fabulous GDP recently. Okay, that's me with the bear, doesn't know what's going on. Okay, let me just move on to the next slide. Sorry, give me a minute. No, it's not. Okay, next slide. I can't change it. Okay, the usual. Okay, let's go through to the current environment right now. Next slide. So the first theme is that, as we entered 2023, I think most of us were expecting a recession. I mean, we don't officially come up with a forecast, but I think most economists, most of the market were expecting some recession. Ours was 40%, because if you put 50, it'd be like flipping a coin. So ours was at 40. Next slide. So the first thing is that growth did beat expectations. I think, although it slowed, but if you look at the main one is actually the nominal, because nominal is what's really happening. So although it slowed, right now you're looking at probably 6% GDP growth. Most were expecting recession. I mean, real is what you'll normally see in the news, but the most important is, of course, the red line, because that's really where the cash flows are, because nominal. And that's still trending, although you can't really see it well, but you look on your left axis, it's still trending about 5-6%. It's far better than expectations. No, the expectations was for some recession, for that blue line to actually drop down below the 0 mark. So we'll just explain why we think why GDP was actually better than expected. Next slide. Next slide. Yeah. Okay, can go back. Okay, so one of the things that happened is that actually third quarter, there was a real perk up in economic activity in the US, especially the US retail sales. You can see on the far left, the big spike you saw, of course, the pandemic, but most of the market observers was looking at the continued slide in the blue line. That means retail sales continue to taper down, but the last quarter, there was actually surprisingly a big spike in the third quarter. I guess it's consistent with what you saw in the strong GDP that the US reported about 6% in terms of nominal terms. Next slide. Then we also saw actually surprisingly even imports. That's what we always like to look at, is the imports going through the US ports. So we get a sense of the data, and that also started to spike up, especially in the third quarter. There was a very sharp decline. So if you notice the blue line, the imports, at least these are containers that goes into the US. So we like to use this to get a sense of the volume. So you can see that it's actually even as bad as during the global financial crisis. You look at 2008, 2009, but we suddenly saw it starting to pick up recently, the recent data. Next slide. One of the things that surprised everyone is, of course, in the US, the labor conditions. So the red line is unemployment. So of course, there's virtually full employment in the US right now. But the other barometer to look at is also the labor slack. That means the amount of vacancies. So one way to understand it is that for every one person who's looking for a job, there's 1.5 jobs out there. Somewhat similar to Singapore too, actually. But if you look at the pre-pandemic, it's 1.2. So it just shows that there's still a lot of jobs out there compared to any persons looking at it. We like to call it labor slack because that's what Jerome Powell actually talked about this data point. He said, although unemployment is low, but another barometer is the labor slack. So it just shows that there is actually still a lot of jobs out there. So until this comes down, then it will also shift their expectations of how they read the economy. So, but anyway, the conditions are still healthy. Next slide. Okay, but one of the things we noticed is that most of the jobs, at least the most recent number, you saw that around 300,000 plus jobs that the US added, which is huge, because usually pre-pandemic they add about 100 plus thousand, 170, 180,000, but recently it was 300,000. But if you go deeper into the data, like almost half of it comes from non-cyclical. So most of it comes from government jobs, education, social spending. So these are not economic sensitive jobs. So that makes us a bit worried because a lot of it is driven by government spending and education. The only private sector that's actually growing jobs is actually leisure activity. This slide just to show you that actually, although you see a lot of headline numbers, it is still below trend. So labor could still be very strong because the underlying normalized, that means the US should be adding jobs according to the red line. But because of the pandemic, they lost like 9 million jobs. So every time you see these very strong headlines, it's actually just to replenish back to June 22. So only in last year, they replenished the labor back to what it was during the pre-pandemic. So what it means is that labor should still be strong. So this will keep the Federal Reserve on its toes that no, they cannot cut rates too aggressive because the employment is still high, like we mentioned, vacancy is high. So why did all this news? So in the end, every macro slide, the key question every investor should ask is like, Paul, you tell me all this, but so what now? So anyway, the so what here is that this will keep the interest rates elevated because the Fed likes to look at employment for whatever reason, it's a lagging indicator, but it will still keep interest rates high because they will view it as that employment is still robust and rates should still continue to keep high because until they see some tail off in labor, that's when they think that they should not go into an easing cycle. Okay, I think sorry, gotta go next again. This doesn't. Okay, so anyway, in conclusion, one of the main reasons that surprised everyone, there are two, but we'll just take one. Why it surprised the whole market, the whole growth in GDP? Of course, this is a very difficult chart to understand, but the blue line, the beige line is a bit hard to see, but that's the amount of fiscal deficit that the government is spending. So if you look at the numbers alone, up to September, the deficit that the US government has, that means how much they actually spend compared to how much they collected, was about $2 trillion compared to a year ago. So what has happened is that there's an increase of 1 trillion in government spending. So behind the scenes, the government is really pumping a lot of spending, supporting the US economy. And that extra 1 trillion, depending how you want to calculate it, it could add about 3.5 percentage points in GDP. So if you think the US is growing 6-7%, almost half of it all comes from the government sector. Of course, the key question we'll dwell on later, can this continue? But at the moment, that is what surprised everyone, that why the US suddenly did so well. Everyone was expecting it. The yield curve went negative. Everything was sliding down. But behind the scenes, especially in the third quarter, there was a big spike in government spending. We'll explain why later. Next slide. So if you look at it on an annual term, so this is an easier chart to read because that's like a rolling 12 months. Probably most people can't really kind of comprehend it better. But if you look at it on a yearly basis, so if you analyze the deficit that the government is doing, is about 2 trillion now. So like the title suggests, so the government is spending double what they did in the pre-pandemic. So pre-pandemic, the deficit, as you all know, usually runs about 1 trillion. But in 2023, this year, the run rate is probably reaching 2 trillion. So you're talking about an additional doubling of. So this deficit, this is not this is what the net. You can think of it like the net amount of spend or support the government is giving, and that they're pumping an extra 1 trillion into the economy, which is like the deficit is like double of what they had. And this is surprising, as probably you keep on hearing this. We're already at full employment, everything is robust, but they still spend at these levels. So the key thing is whether can the deficit continue. Whether they will continue to maintain at this rate. Next slide. The other thing that is also helping the US economy is, of course, I think we've shown this before, but this credit card spend, this is quite huge. I think if you think of it, if you look at the numbers in the middle, it just shows that there's an additional 100 billion in credit card spend. There's also another support to the economy. Of course, makes you worry too, because then the quality of the consumer, the growth, the retail spend, the quality is also, I wouldn't say a bit suspect, but it's something to also be noticeable, because if you're using a credit card to spend consumer spending, which we all know is the most expensive cost of funds, then that is something that we are, of course, a bit wary of. And you compare it to the pre-pandemic, you're talking about only 40 billion plus. Even you want to adjust it for inflation, it's still a huge number. So they're adding almost 100 billion in credit card debt to kind of fuel the retail spending, which is almost hitting about $1 trillion right now. Next slide. The other thing that we noticed too is also like the inventory is also piling up in the US. If you look at we always like to look at pre-pandemic to get the normalized, but in 2022, there was an exceptional jump in inventory in the US from 600 billion to 700. Of course, in part, this was due to the supply chain issues. So everyone had to stock up. And that's the reason why we also see the electronics demand in the whole of Asia actually came off, the momentum coming off, because you can ask any furniture maker, they're probably telling you they're not selling anything to the US, because if you just look at the inventory that they have. So this is mainly more impact for exporters. But it also just shows you that, because if you look at GDP, adding inventory is one of the components. So if we're just trying to show the quality of the growth is a bit worrying for us, at least in the US, because they are continuing to pile up inventory. Why we said 1 trillion, of course, if you normalize it, this is up to, I think, August or September. If you normalize it, the US could be having almost 1 trillion of inventory. So that's something to worry. And it's not very good for exporters for the whole of Asia too, just as a side note, because the US is just too much inventory. If you can see pre-pandemic, of course, pre-pandemic is not a good barometer because retail still continues to grow, but it is still something to worry about, because the delta here is actually quite huge. Next slide. Okay, so one of the things, of course, one of the most, the talking points in the US always, interest rates are so high, why hasn't it affected the economy? One of the reasons, of course, before I go into the chart, if you look at the table here, if you look at mortgages, unlike in Singapore, where if your interest rates rise, the bank's going to call you, not call you, I mean, they're going to send you the letter, tell you your rates have just increased. But in a typical bank, if you look at mortgages, it's like 70 or 2/3 of it is actually on a fixed rate. So that's why the US consumer doesn't feel the impact of the higher rates, because it's fixed at I don't know, 1 or 2%. Of course, this is probably the flip side in Singapore. Probably Singapore is mainly all floating, so we're all getting punished by the higher interest rates. But it doesn't happen in the US. It's like 2/3 of it is fixed. And of course, most of it is more than 5 years. So that's why the consumer has been protected by the high interest rates. Then if you swing it back to the corporates, so far it hasn't really impacted. If you look at they have this, I know the US collects all kinds of data, but if you, strangely, but if you just look at the amount of interest to corporate profits, it continues to decline. So it hasn't really impacted yet, but it should be impacting it, because if you look at the corporate line, again, the data point, about almost 90% of the corporate loans are all floating, and most of it is less than 5 years. So we think the interest rates hasn't impacted, but it will start to slowly hurt, or I mean, lack of a better word, kind of hurt the corporate earnings as it climbs up. But of course, it doesn't hurt the big tech firms, they're all net cash. But in terms of the whole corporate sector, that's the reason why you don't really see the high interest rates impacting the US economy yet. Next slide. One of the reasons too, of course, so the first reason why the US did better than expected was, of course, the deficit spending. Then if you recall, in March, we had, I think 3 or 4 banks that went to bankruptcy. But even then, the US economy didn't falter. I mean, the stock market faltered a little bit, but you can see that recovering is mainly because there was a lot of bailouts. The bailouts peaked at almost 300 billion. So these are year-end, these are month-end numbers. So I think global financial crisis probably hit, if I can recall properly, it's about probably 500 billion in Federal Reserve loans. So these are loans that the government give to the banks. But you notice that's why behind the scenes, why the US did well is also not only did the government support the economy, the Federal Reserve also support. So how does they support? They got this another acronym, I think BTP. But what they do is that because all the banks are stuck with all these bonds and they were losing money. And of course, if you mark to market, most of them probably could even wipe out your shareholder funds. So, but what happened is that they will just, all the banks will just line up. I mean, I'm just exaggerating, but they'll just line up with the Federal Reserve. They just give the bonds to the Federal Reserve, and the Federal Reserve will give you cash. So so basically, whatever losses you had, you could actually park it with the Federal Reserve in exchange for your treasury bonds, which of course is losing money, but then the Federal Reserve of course keep it. Of course, part of it also FDIC support. But I mean, so the other key point why, even though you saw four banks failing, the US still continued to do well is also because there was again Federal Reserve support as large as the global financial crisis. Next slide. Okay, so that's the team. We'll go to the conclusions later. I mean, again, like any macro chart, not so what you tell me so much about. Okay, so the next theme is that why we also saw bond yields suddenly spiked up so much in the US to 16-year highs. It crossed 5%, but I think it's probably now back down to 4.8. Next slide. Okay, so obviously we always kid around that the best in the finance industry, the best was to be a fixed income fund manager, because you had a 40-year bull market. Most important was you just come to office and then you can enjoy this. Obviously, I took the wrong one, I took equity, so I suppose Singapore equity. So, but if you had been a bond manager, the last 40 years was just come to office and you have done really well because there was a 40-year bull market in bonds. Will it be ending? Probably. I'm not the bond analyst, but we think risk could stay. I think we all know it's going to, unless we have some major dislocation or major geopolitical event. I think bonds will not go back into that sliding range, obviously, because it went negative or even 1 or 2% plus. But right now, we still think bonds broke up. We're just trying to explain to you why suddenly bonds are spiked up. Next slide. So one of the reasons is there was a lot of supply that came up. So if the past 4 months alone, the amount of bonds that came up to the market was almost 1.7 trillion. Of course, it's going to be almost impossible for the market to absorb so much. A year ago, the supply was only about 300 billion. So there was just a lot of bond supply that came into the market. One of the ways this is called help by public. So these are bonds not owned by the government, because the Federal Reserve also owns bonds. So excluding this, you will notice at least if you calendarize it just for ease of observation, you notice that there's almost 2.4 trillion of bonds that came up. One of it was, of course, the deficit, like we mentioned, 1 trillion new, because your deficit goes up means the government has to borrow more. So because the government borrows more, it has to issue additional 1 trillion. Then at the same time, you have quantitative tightening, where the Federal Reserve is also selling bonds to the public, which is the market. I mean, that's a nicer word, it's just called market. So the market just had to absorb too much bonds. The supply was too much. It's not so much about the foreigners selling, otherwise the US dollar won't be climbing, but it's mainly just a lot of supply in a very short point in time. Next slide. Okay, we'll run through the conclusions later, so don't mind me. I'm like throwing a lot of data to everyone. So another reason why the bonds also went up was since the FOMC meeting on September 20th, they basically guided to the whole market that interest rates will be higher. So as a result, so this is the Fed funds expectations. So this is where the futures market is pricing interest rates. So this is not my forecast because it's usually not right. But if you look at the number there, in December, for November, that means next week, the market is only expecting that means not expecting any rate hikes in November. Neither are they expecting any rate hikes in December. So what it means is that the futures market is not expecting any more rate hike by the Fed. But what they think is happening is that in the second quarter, third quarter, there'll be one cut in the next second quarter to the as you can see from the table, but one of the reasons why the bonds also yield went up is because of the expectations. So if you look at the red line is where the market expected interest rates to be in June. Then it moved up a little bit in August, the green line, but by September, you can see it just spiked up very sharply in just just a couple of days actually. It's mainly because of the FOMC meeting, because the FOMC basically guided everyone that interest rates will be higher. So that's why you get this phenomena, why yields also spiked up, because the whole curve just spiked up. But even then, the market is still expecting 3 rate cuts. We think it's probably going to be just one. I mean, our own guesstimate. But that's one of the reasons, just to explain to everyone why rates spiked up so much. Next slide. Okay, having spent like 20 minutes giving you a history lesson, we just tell you what we think is the outlook. I find this more pertinent, and most of it is probably what we shared in our recent strategy, because that doesn't. So that's me trying to, that was the image I was trying to look at, fortune teller standing on the mountain looking at the horizon. So that's the macro outlook. Next slide. So we still think there's no difference to our view where we share our strategy. We still think there's going to be multiple drags to growth in the US, but we doubt it. Even if there's a recession, it's very shallow. I'll tell you why. But next slide. So one of the things is, again, excess savings. I think again, very complicated chart, but just that the other thing. So the two things that surprised most of the market was, of course, the deficit spending by the US. And the second thing was the amount of savings that the consumer had. Even though they were saving less, if you look at the blue line, they are saving probably right now about 50 billion, uses 100 billion a month. But because they accumulated so much savings during the pandemic, almost 2 trillion, they could save less because they have a lot of savings left to spend. And even until now, they're still spending it. Probably could end maybe end of this year or even first quarter of next year. Next slide. Of course, we had a joke about this, but this is Social Security. So this is the gift that keeps on giving. So Social Security is every 9 out of 10 Americans above 65 get Social Security. Average is about 1,800. So this is the gift that keeps on giving, and will always. It is the best thing to happen for the US. Until you have a doom cycle of higher interest and so on. But in the meantime, the US government spends about 1.4 trillion on Social Security. That means give retirement benefits, I mean, in a way, 1,800 a month. And that saw a big spike in 2021, 2022, because they have cost of living adjustments, COLA, because when inflation rises, they will climb, but this will drop in 2024. So this will be one of the drags to the economy. But underlying the US economy is Social Security, because this is the thing that this is like 1 trillion thrown to the households' pockets. So this is really the biggest support. And this will never go down, because no president will want to cut social spending. So this is really the backbone to the whole US consumer, which is the Social Security. Next slide. So the other drag is, of course, I think I won't run through this. I think everybody knows. Just that student loans will start to kick in October. So if there's any impact of it, you'll start to see in the fourth quarter. But we think 2024 will get a stronger impact. Next slide. Then, of course, interest rates, I think we know this. I mean, one thing is that when of course, real interest rates, nobody really cares. I mean, if you're in the business world, interest rates. But I guess it may start to impact, in theory, at least, investments and savings. I mean, if you're a corporate, I mean, this is from the corporates that we speak to, at least from here, is that if interest rates are high, would you rather spend the returns that you get from an investment the hurdle rate will be higher. So this will, of course, impact investment decisions. I mean, I'm just reading it off from the textbook. Okay, so this is the typical thing when interest rates are high. Likewise, would you want to consume versus save? So although you have the lag impact, but there will be an impact coming. There will be a drag also to the economy as we move into 2024. Next slide. Again, this is the same slide that we showed before, so I won't run through. But again, China is 30% of the net incremental global growth. And that is slowing down. Next slide. So one of the things, the problem, we updated this. So China used to sell like 15 million units of homes. We estimate it should be more sustainable is 7 million. So now it's 9 million. So so why is this important? No, like we mentioned before, no, Chinese property will impact the upstream, it impact all the commodities. It will also impact the downstream. No? If you look at China retail spend, like furniture, anything related to property is all coming down because of you can see what's happening in the property market. So there's this one upstream effect, downstream effect, and there's also a government effect because the local government relies a lot on property sales. So although you almost as much as 2/3 if you include all the indirect impacts, it's going to be affected by property. So property we initially thought the authorities will come in to support, but it's probably unlikely they will do so because if you do it, then you have then it's like back to the future again. So you're going to have another issue again. So in a way, of course, if you're a country guarded shareholder, that's probably not a good thing to hear, but in a way, all these bankruptcies is helping out to flush out or to help the whole sector de-gear. Of course, if you're a shareholder, that's not good news. But if you holistically think, if you're from a holistically or a top-down approach, these bankruptcies in a way is flushing out the excess in the system because the government comes in and support again, then you're going to have another round of issues. For my interactions with the Chinese developers, which are very little, but I remember in 2016, 2017, we always asked the developer, aren't you worried about gearing? So the common reply they give us is that he who gears the most is the winner, but I guess until now, but at that point in time, the only way to be big was to gear. So they always thought that gearing, then you'll be the winner until now. So we think it is a very tough process, but it's something that needs to happen to flush out all the excess investments in property. Next slide. Okay, then one last one for outlook is that whether we get a very sharp recession in the US really depends on almost on this chart, whether you have a huge bad debt cycle coming up in the US. So far, we don't see it's normalizing. So we don't think that any recession in the US, if it does happen, will be sharp because you're not getting a bad debt cycle or provisioning cycle in the US. So that means the banks have to do a lot of write-offs. It was slow, but it may not trigger that kind of a deep slowdown or a shock to the system. Next slide. Then one second last thing for me is that we still think there's a rate cut. Next slide, probably in the fourth quarter. We still think that inflation is going to trend down quite sharply. If you kind of trend line the current numbers, which is the core PCE, which is another, basically what the Fed likes to look at, their target of 2%, which is the green line. You could probably trend line it to 3.3 by December, which is below the Fed's forecast, and could come near to maybe 2 point something, quite near to their 2% probably by middle of next year. So we still think there's room for a cut. But it's going to be quite at the tail end of 2024 because we still think inflation is still heading downwards. But most important is housing inflation. That's the one that's holding up, and it's a very long lead time housing to turn around. But we already seen it turn around, so that's why we think inflation will still be trending downwards, and that will cause a rate cut by end of 2024. Next slide. So one thing is that one more last portion for you before I hand it to Jonathan is that. Although rates have increased, there is an impact. So what we realize is that although the US, the increase in treasury yields in the US is affecting the emerging markets, Asia, Europe, and everything. Because what's happening is that when the rates in the US is 5%, it's pulling up everything. That's why we saw rate hikes in Indonesia, rate hikes in Philippines. And if you think about it, if the US can give you 5%, like, would you want to invest in an emerging market kind of, not nice to mention the countries, but I think you can imagine if the risk-free rate is now 5%, anything that's below is going to face pressure, if not currencies. That's why even Turkey, everyone's all raising rates. Next slide. So one of the things that's happening is, of course, even before the recent spike in rates, you notice that the US debt market is absorbing global capital. So that's the issue that we're having now is that, of course, if you're in Asia, US, because of their current account deficit, they are absorbing almost $1 trillion in debt. And this is before the recent spike. So this is up to June. So one of the phenomena is that not only is the US absorbing global capital in equities, they're also absorbing global capital in debt. Next slide. Okay, there's a lot of numbers here, but what we're just trying to show you is that if you look at the numbers at the bottom, let's say you take Indonesia. So Indonesia, the average is, they usually tend to be 5 percentage points higher than the US. So if you look at the IJs, right, you look at IJ, right now Indonesia is only I think 7% supplant, 7% plus. So what it means that what we worry is that although the US rates have climbed up, there could be upward pressure on all the interest rates in the region. So, really feeling it, like we mentioned, Philippines, in Indonesia, in part to support the Indonesian currencies and so forth. What we've seen is that when interest rates rose recently, the Italian rates rose and so forth. So we're just worried that it will just pull up, and it will also cause global growth to slow, of course, when interest rates rise. So this is not peculiar to just the US that rates have risen. It's also going to kind of hurt. It's going to tighten monetary conditions for the rest of the world. This is just for your reference. I mean, this is a talking point. So that the row there is 10-year average. So that's the difference is with the US. Minus means usually it is 5 percentage points lower, and then the fair value should be 9. You just take the historical average. But right now, it means that, let's say you look at India or Indonesia, their interest rates should actually rise to 2.8, 2.7 to meet the average. And likewise for Malaysia, I guess. To kind of hit with the fair value of the 10-year average. Again, this is just a numerical exercise. It doesn't mean you do it that way. But just to push the point that it's going to impact the global financial conditions. Next slide. Just a quick one on equity valuations of the US. Next slide. Okay, so this is the CAPE, the famous CAPE-Shiller index, the red line. Not the best for timing, but just to show you where valuations are for the US. So right now, it's obviously not cheap, but it's probably still at the high quartile. If you look at that, just for your reference. Next slide. And then what we notice is the blue line is earnings. Earnings growth has decelerated a lot. Even though the market, so the strange thing is that even though earnings has decelerated, if you look at the red line, which is the year-on-year growth, so it's probably at 1 or 2%. But the equity market continues to run, of course, up to the past 1-2 months. But you notice that earnings continue to, there's no growth in the earnings, but just the expectations, the PE expansion was just very strong in the US, just for your reference. Okay, I think that's my last slide. I think hand it over to the more interesting part, which is some of the stock picks. Next slide. So I'll hand it over to John on some of the key stock picks. Okay, it's working now. Yeah.
Thanks, Paul. And good morning, everyone. So like Paul mentioned, I'm Jonathan. I lead the US research team here at Phillip. We currently cover almost 20 US companies, ranging from your big tech guys to maybe some of your I guess, not so big Singapore HQ companies that are listed there as well. So based on our stock picks, it kind of runs through a few teams. The first team would be, I guess, cloud AI, anything related to AI right now, some of your digital advertising as well as your EDs. So the first stock pick we have is actually on Alphabet. They just announced their third quarter earnings a couple of days ago. In terms of Alphabet, what we're actually looking for is, or rather, what are the merits for Alphabet is advertising looks to have bottomed, especially after a really bad, I guess, year and a half, since somewhere towards the end of 2021, advertising has just kind of fallen off a cliff. We can see this quite clearly in the chart. Ad revenue year-on-year growth has continued to decline. It was actually negative in the fourth quarter of last year. But what we've seen over the last, if you include this past quarter as well, which year-on-year growth for ad was about 9%, you can see sort of a recovery in advertising. We think some of it was, well, obviously the initial decline was mainly due to a lot of worries over consumer spending in the US. But as we see, spending still remains fairly resilient, and I think a lot of advertisers are starting to start their spending again, especially as the long holiday season kind of approaches. So advertising, obviously, if your whole industry starts to ramp up, and if you're basically the leader or you're almost the monopoly player in this industry, you stand to benefit the most. Our second point is AI continues to drive better products, and it actually helps to increase monetization. So the one thing that Alphabet has actually been facing is sort of a lack of monetization for its short form video platform. So for most of its ad revenue comes from its search, right? You got your print ads. Then at the same time, they also have YouTube. And in recent times, they've introduced YouTube Shorts. And generally, when you look at short form video compared to just your static print ads, the monetization is a bit less because there's less opportunity, there's less ad placements. So if I'm an advertiser, first of all, I have a hurdle in whether I'm able to actually create these kind of short form video ads that last maybe 5 seconds, compared to a print ad that, you just do a print ad, you stick it there. And then, as placement comes along, maybe your short form video is only 30 seconds, right? Or maybe 20 seconds. So there's only real placements for ads, not even within the short form videos, but maybe after every 2 or 3 videos, then you've got one short 5-second ad. So monetization from this kind of transformation has been an issue. Obviously, they've been working through this, and monetization has been improving a little bit. So when it comes to the AI portion, firstly, Alphabet has quite a strong cloud presence. They're the third largest player in cloud space behind AWS, which is Amazon, as well as Microsoft. Microsoft is Azure. And so just generally with a lot more companies investing in AI or being more involved in AI, they need a little bit more infrastructure, they need a little bit more, I guess, more cloud activity. And this comes from, not just Alphabet, but also Microsoft and AWS. And so just because they're one of the biggest players, they leverage a lot of AI in their products, like their search products that they are trying to improve, and their Google Cloud productivity, I guess, softwares. This kind of helps to drive a little bit more monetization. They're saying to their consumers, we have a better product, we can charge you a little bit more, and consumers are generally a bit more willing to pay, I guess, from a corporate standpoint. Lastly, like most other tech companies, they really cut a lot of their headcount. They've also cut a lot of office facility space, so they're making their company a little bit leaner. And so with this leaner cost structure, with a lot of especially digital advertising companies, essentially they have a lot of operating leverage if they're able to be a little bit more efficient. That's what we are seeing right now with Alphabet. When you look at their recent earnings, net margins improved by almost 6% year on year. Their earnings increased about 45 to 50%, which is quite significant. And the biggest reason for this is not so much top line growth, but they've just reduced a lot of their expenses that they deem as, I guess, not a priority or not so important. And so because of this, because of the advertising industry kind of improving, we actually have a buy recommendation, and this is one of our top stock picks for the digital advertising industry. So moving on to my next counter, which is Tesla. I think everyone should be quite familiar with Tesla. The 3 main key points for Tesla is that they have a superior product compared to a lot of your EV makers. I mean, BYD is obviously coming in very strong, but I guess BYD focuses a little bit more on the mass market instead of your I guess high end or your premium automotive market. Demand continues to be very strong. They continue to grow their deliveries about 50% year on year. This past quarter, this past 6 months has been a little bit weak, but mainly because they actually had some downtime in their factory, so they weren't actually able to deliver that many vehicles. At the same time, your wait times for a lot of your vehicles used to be maybe like 6 to 9 months in the US, but this has come down a little bit to quite significantly, actually, to about 1 or 2 months, mainly because they've ramped up the production quite significantly. But we still think that long term, they're going to be the leader in the EV space. There's a lot of brand loyalty in the US. I guess not just US, but Europe as well for Tesla cars, even though competition is emerging. Our second point is that they have industry-leading margins. So right now, their margins are about 18 to 20%, which is basically double your overall industry average. So industry average is about 6 to 8%. It's quite significant because they've been able to do this by being more efficient in their production, by manufacturing parts and designing parts that are I guess, more easily put together. So instead of maybe like 3 parts, they combine these 3 parts and just make one bigger part, like your door panel or something like that. And so this kind of saves costs. It's easier for them to manufacture, and easier for them to assemble, so they can churn out more cars at the same time. When you look at this chart, it's the cost per EV, average cost per EV. You can see, when they were kind of first sort of beginning in 2017, 2018, the average cost per EV was about $75,000 US. And right now it's down to about 39 to 40,000 US dollars. So you can see kind of a 40% reduction in cost. A big part of it also comes from batteries, because batteries make up about 1/3 of the overall car. And so they've been improving their battery technology, making it more efficient, last longer, I guess exploding and overheating less, compared to a lot of I guess, other EV manufacturers. But lastly, it's a big industry tailwind, not just for Tesla, but for your other EV players like BMW, BYD, NIO, and so on. You've got your big net zero emission tailwinds. Most of it is globally, and most of these net zero emission tailwinds kind of kick in like 2030, 2040. So there's a lot of incentives for manufacturers to come up with your EV cars instead of your traditional ICE vehicles. And just basically based on this kind of push, there's a lot of incentive for consumers as well. When you purchase a car, you get maybe $7,500 tax rebate in the US. And not just that, in China as well, there's a lot of push for not just your EV consumer, not just your EV manufacturer, but also all your, I guess all your downstream players and upstream players as well, like your lithium manufacturers, and so on, your battery manufacturers. So there's a big push for EVs and for electrification. And we think that this obviously will help Tesla, given that they are the leaders in this space, but not just limited to Tesla, to the other EV players as well. We actually have an accumulate rating on Tesla. Next slide. Oh, never mind. Okay. Yeah. So my next stock pick is actually Spotify. Most people actually use Spotify. It's one of the top audio streaming platforms in the world. And the key thing for Spotify is that actually they've not been able to make a profit for quite a while. But we're starting to see this change a little bit as they reach scale. So right now they've got, I believe, slightly over 560 million monthly active users, which is MAUs. And the monthly active users are essentially your free to use. You can just download your Spotify app. You can go on your platform. And so there's very little monetization there, but most of the monetization comes from your premium subscribers. And the biggest funnel for premium subscribers is your free MAUs. So essentially what Spotify tries to do is they tries to convert a lot of these free users into to paying subscribers. And so far they've been quite successful at this. The ratio between premium to MAUs is usually about 0.4. So 40% of your MAUs get converted over, which is a pretty strong rate. If you take a look at other players. So what we're seeing right now is user growth continues to accelerate in the 20% range. If you talk about just premium subscribers, it's about high teen, 15 to 17%, which is very strong given they have quite a lot of users around the world already. And user growth doesn't really seem to be slowing down, especially as they penetrate more developing markets in APAC and I guess Latin America as well. And so with more users, it comes a little bit more profitability because they have I guess they can also leverage on their operating leverage. They have a lot of fixed costs in their licenses, so they I guess they sign deals with your labels and stuff every year, and for podcasts, for music, for audiobooks and stuff like that. And so a lot of their costs is actually fixed. And so what we think is going to be happening moving forward as they get more users is they're going to be improving their profitability. That you just saw last quarter that they announced their earnings. They finally had 2 straight quarters of operating income. Just one quarter of operating income, but it's looking like this is going to be the mainstay moving forward. And then obviously the company also guided for stronger profitability moving forward. And so we think that obviously if you can make money and you're growing at scale and you have a bit of pricing power, you're able to raise your prices, which they just did for the first time in I think over 2 years. Then you have a company that actually has some sort of advantages over the rest of the field. Lastly, since they are a tech company, they also leverage a little bit of AI to drive some form of better reach. So in terms of their newest product, audiobooks, essentially it's like you take a book and then instead of reading it, you can just listen to it. They have AI technology right now that they're able to kind of convert these into different languages. So just by virtue of that, you're able to reach more consumers. And it's not just for audiobooks, but for some of their podcasts as well. When they do a lot of their captioning, they can caption it in different languages. And so this is just allowing their products to reach a wider audience and providing a little bit more value for the customer, instead of just having it in maybe one fixed language and so on. And so we think that, with the possibilities of AI, they're going to continue to improve. They're going to be able to make better products, kind of pull away from its competitors like maybe Apple or YouTube Music. And they should be able to cement their leadership position in this audio streaming space. We also have a cumulative rating on Spotify. So my next founder will be Amazon. They just announced their earnings, I think like 2 days ago. And the biggest thing for Amazon is just margin expansion. They've really cut a lot. I think they cut like 27,000 workers, both full-time as well as part-time. You can see in the chart here, on the right side, in the big red box, you can see operating margin expected to continue climbing. It was 5.7% at the second quarter, and this quarter I think it's closer to 8 to 9%. So you can see this kind of expansion continue to happen. A few reasons for this. Firstly, a lot of their cost is in logistics, so to deliver the parcel to their consumers. And right now with cheaper fuel costs and I guess your supply chains easing, your logistic costs is a bit cheaper. They're able to leverage a bit of that and I guess make it a little bit more affordable for them to deliver the products to you. At the same time, they also built better infrastructure in their logistics facilities, where they make it more efficient for parcels to come out, so it reaches the customer in a shorter period of time. So that's for just for the e-commerce business. On the other side of the margin expansion, you have their cloud business, which is AWS, which is the second point. AWS is the leader in cloud infrastructure, so they stand to benefit the most from generative AI because a lot of companies that want to use AI, they maybe don't have the capabilities to go in or the cash to go and build their own data center. So they just park their stuff in AWS, pay a monthly subscription, and leverage on AWS's services. And so it's just a natural progression in terms of what corporates are trying to do now, especially with AI. They're just going to move all their businesses, or more and more businesses going to Google Cloud, Azure, and AWS. And lastly, which is not a point that's not talked about that much, is advertising. We think advertising for Amazon is a very big opportunity. Right now, it makes up less than 10% of their total revenue, so very small. But in their latest earnings, advertising actually grew about 25%, so it's a faster growth rate than most of the other larger advertisers. One thing about Amazon's advertising and why it's so effective is because they capture a lot of their own first-party data. So whenever you go on an Amazon website, they can capture what you buy, what you're looking at, and so on. Whereas most other companies use third-party cookies or third-party data, which sometimes is a little bit more difficult to interpret and more difficult to synthesize. So for Amazon, they're able to capture a lot of your first-party data and maybe have better recommendations for a lot of the consumers. At the same time, most of the people that are on Amazon are already ready to buy something, so it doesn't take a lot of push for them to see maybe another complementary product that they may not be looking at. That they're like, okay, maybe this is a good product to buy. If it's at a good price, I'll buy it right now. And so we think that advertising, because Amazon is able to capture a lot of their own first-party data, has an advantage over some of the other third-party advertising companies like even Meta and so on. And so we think that advertising will continue to grow for Amazon, and it should be a big opportunity moving forward. Maybe not next year, maybe not even the year after that, but at least maybe 3 to 5 years down, it should be a little bit more substantial. So that's why we have a buy rating on Amazon just for margin expansion and other growth driver from advertising, as well as just AWS growth being the monopoly here. Next counter will be on NVIDIA. I think NVIDIA has been one of the most hyped up stocks for the last 7 to 8 months. And rightly so, because they said they are the leader in generative AI. All the Gen AI products have to run on their GPUs because they basically make the best GPUs in the market and the most capable ones to actually run these kind of large scale, high efficiency, high intensity products and applications. And so for NVIDIA, they're expecting a really strong second half. They've got orders booked all the way until early next year. So all they have to do is just keep churning out their products. The benefit for NVIDIA is that they are making and they're selling their newer generation chips, which they're selling at I believe at twice the cost of their older ones. And the reason why everyone wants to buy their new chips is because it's the newest, it's the highest spec, blah blah blah, like every other iPhone as well that people want to upgrade to. And so just based on that, when they're going to charge a consumer or a company else to buy like twice the price, it obviously doesn't cost them twice the amount to make it. So you're going to see some sort of margin expansion over there. Our last point is from NVIDIA is that even though they have a Chinese business, makes up about 20% of their overall revenue, we don't think that there'll be any immediate effects from curbs, that the US is trying to place on its Chinese business, just because demand is so strong from everywhere, not just from China right now, from the US, from Europe, from all other parts of the world, that we think that there may be some side effects, but very limited in terms of, when you're growing like 60-70% year on year, maybe a 3 or 4% year on year growth doesn't really affect the company that significantly. And just because of these reasons, because we think that the generative AI is going to continue moving forward, we have a buy rating on NVIDIA. My second last stock is actually Microsoft. Microsoft is I guess two-pronged. The first prong will be your Office 365 productivity software, and the second will be your Azure, which is your cloud services, which are the first 2 points here. Office 365 is essentially still in very high demand. Most of its customers are corporates, so it's a mini B2B business, which generally is a bit more sticky. At the same time, they've been raising their prices on their 365 products, so that they're generating better revenue from that, better margins from that. In terms of their Azure, like AWS and like Google Cloud, Azure growth it has stabilized quite a bit. Actually, over their last earnings call, Azure growth re-accelerated from 22 to I think 29%. So you saw this really significant acceleration in growth as more and more people kind of shift to the cloud and use Azure, AWS, and Google Cloud. And the last point that we have here is just a caveat that consumer PC demand still remains a bit weak. Not many people are buying new PCs or buying new hardware, and this is quite common because hardware is very cyclical. It's like you're not going to buy a new PC most people don't buy new PCs every year. Usually they wait like 3 to 4 years, and this is similar to not just PCs but phones as well. And so the main drag on Microsoft's growth is that there is some weakness there, although we think that this is fairly normal. When you look at the chart here, PC growth is, I guess PC is not growing. It is down 9% year on year and has been declining over the last 3 or 4 quarters, more or less. But we think that this is fairly limited, because when it starts to pick up again, when people start buying PCs, then you've got all 3 growth drivers firing on all cylinders, and that should help to benefit the company, I guess, more than what it is right now. So we see quite a bit of upside for Microsoft. It's the leader in obviously Office 365. Not many people I know use Google spreadsheets and stuff when you're coming to B2B customers. So we have an accumulate rating on Microsoft. My last topic is actually Salesforce. It's a little bit different. Salesforce is a customer relationship management tool. And the one good thing about Salesforce is that it has this sort of multi-cloud service. So it's got your sales cloud, and it's got service cloud, and then it's got your 360 offerings, where it bundles together all its product into one service center. And this is quite beneficial because a lot of their B2B customers, instead of just buying one standalone product here, one standalone product there, they just go to Salesforce and they're like, hey, we want all of it. We want it because it gives a better view. It's more cost effective, as well as you only have to deal with one vendor, which is Salesforce. They just introduced a price hike of about 10%, first hike in more than 7 years. So when you have a price hike like that, most of your 10% just goes straight to your bottom line margins, and it shows a lot of pricing power compared to some of its competitors like HubSpot and so on. They just like, hey, we're going to raise prices by 10%. Not really that concerned about people switching away from our products. It's just a really great business that you want to take a look at. At the same time, like most other tech companies, they also started to cut a lot of their costs at the beginning of this year. And so you have this cost-cutting measures, plus you add your increase in your prices, just helps to expand the margins quite significantly. You see this in the chart here. Your net profit margin basically for this year is almost flat, but you can see over the next couple of years, it's increased quite significantly, just based on your operating leverage. And big reason is because Salesforce is starting to get to scale as well. More and more corporates are choosing Salesforce for a lot of their businesses. And we think as adoption kind of increases, with their fixed costs, they're going to be kind of maintaining your fixed costs around where it is right now because they don't really need to expand that significantly. We think that should help to benefit most of the margins and Salesforce as a company. So we have a cumulative rating as well on Salesforce. Yeah, so that's all for the stock picks. Maybe I'll hand it back to Paul to wrap. Oh yeah, sorry. So this is just a brief summary of our stock coverage. So we have Adobe, we got Salesforce, we even have like Simulator and stuff like that. Yeah. Yeah. Okay. So I guess I'll just do the conclusion. In conclusion, from what Paul has mentioned, the economy has kind of been propped up by a lot of your fiscal deficits as well as credit card spending. So maybe the health of the economy is a little bit in question right now. We'll see how long they can sustain this. And we think that in terms of I guess growing into next year and maybe the year beyond, there should be some drags like Paul mentioned earlier, from excess savings, some of your cost of living adjustments, and then everyone has to start paying their student loans. So you got just less free cash flow that they can spend on consumer products, as well as so I think slowing Chinese growth is kind of a big deal because they are such a large economy, and so far what we've seen and it's very different from the expectations of what China was, I guess, popped up to be. We expected a lot more injection from the Chinese government to kind of help to resuscitate the economy after COVID, but that has been quite delayed and hasn't really turned out. So obviously there's quite a lot of drags on the US and just your global economies in general. In terms of our key buys, those will be Google, Amazon, and Nvidia. Like I mentioned earlier, most of these are I guess your monopolies in this space. Google, definitely your search advertising, everybody goes to Google. For Amazon, e-commerce in the US, it's really only Amazon and most of the world as well, in Europe as well. And then for Nvidia, for a lot of your AI picks, whenever people want to I guess leverage on AI technology, they just kind of need to buy their stuff from Nvidia. And that's kind of why these three guys are our key buys for at least for this current quarter, maybe even for next quarter as well. Yeah, so with that, I've come to the end of our presentation. I'll hand it over to Jay to do some of the technical analysis. Thank you.
All right, Jay's just setting up. So in the meantime, I'm just going to remind everyone that's tuned into the webinar to put in their questions on Slido. So we're going to have that come up right there. I believe everyone here as well can put their questions in on Slido as well. If you have any questions, we will have a Q&A session later. So just join it at slido.com. The number is 2683-525, or you can scan the QR code. Jay is setting up. In the meantime, have some coffee, have some tea, have some water as well. We'll be with you shortly. Thank you. Okay, fantastic. Once again, thank you so much for coming down to our event on this beautiful Saturday, combining technical and fundamental wisdom in trading. For all those that have joined us on the webinar, I will remind you right now to upvote the questions that you want answered first, and that's what we're going to do later. So stay tuned for the Q&A section. Now it's my honor to introduce Jay Tun, founder and trainer of Swim Trading, who is also an independent trader, to join us. Thank you. Please welcome him.
All right, great. All right, good morning, everyone. Come on, I'm sure you can do better. Good morning, everyone. All right. So do you enjoy the first session by Paul and Jonathan? Okay, so how was your morning? Is it good? Okay, so what I'm here for, right, is to follow up on what Paul and Jonathan has mentioned, which is just now largely they have covered fundamentals. So my job over here will be to touch up, to expand a little bit on not just the fundamentals, as well as what the macro outlooks that I have, and what are some of the actions that we can be taking moving forward. Is that okay with you, everyone? Is that okay? All right, good. So I love the energy. This is a little bit of, intro about me. I can see some familiar faces over here, and I'm an independent trader. Some of you may think that I look young. Just make a guess. How old do you think I am? How old do you think I am? Don't tell me 18, don't tell me 50. In between that range. Shout out any number. 35. Yes, quite close, quite close. Okay, I'm 36 this year. So I've been trading the US market for the last 12 years, and this is my first and lasting job that I do. So by independent trader, right? What's that? Oh, your mouse. Okay, by being an independent trader, meaning I don't represent any firm, I don't represent any institution, I just trade my own funds. And my focus, right, is largely on the US market. So I don't really touch the Singapore market. I focus almost exclusively on the US market. Can I have a show of hands? How many of you trade the US market like I do? Okay. Hong Kong market, anybody? Okay. Singapore? Oh, Singapore still have lah. But how is the Singapore market doing so far? Not so good, right? Okay. So another thing about me, right, is I do have I'm an ACTA certified trainer, which means that what it means, I don't like to present. I like to have a conversation with all of you this morning. Is it okay for all of you to participate and for me to ask you questions? Is that okay? Okay, because I mean, we are all here physically, finally, not on Zoom, and I can see you, you can see me. So let's have a little bit of interaction. So when I ask questions, yes, no questions, what must you do? Thank you, thank you. So give me an answer, you can nod your head, and if I ask you to, okay, any questions, you can just, sound out the questions that you have, send it over to the Slido. Is that okay? Okay, so are you all ready to begin? You don't sound too ready, leh. Are you all ready to begin? Okay, very good. Now, you may have seen me featured on some other, stages like Traders Fair, Invest Fair most recently. And today, right, it's all about you, which are the esteemed clients of Phillip Securities. So now, today, right, this is what I want to start off with first. Number one is this is the state of the US market so far. So 2023, year to date. So YTD is not shorthand for yesterday. I know you all send WhatsApp text, right? YTD, yesterday. This is not yesterday. This is year to date. So January of 2023, we started right there. And starting of the year, for some of you that have attended some of my other webinars before, I have always included a bullish stance since the starting of the year. For the reasons, right, that was outlined, earlier by Paul just now. He talked about interest rate. So last year, the interest rate was, the trajectory of that interest rate increase wasn't as certain as we are since the starting of the year. At the starting of the year, we begin this year with we ended last year almost with 4.75%. And right now we are at 5.5%. With all these factors out of the way, right, what happened was that there was nothing left for the market to speculate in that sense. And therefore, right, I thought that with all the macro factors, the uncertainties that are out of the way, and the market naturally should, clear up itself and resume the normal movement, which it did for the bulk of the year, all the way until the National Day period. I remember this because it was 29th of July. Okay, it was 29th of July. I was going for the NDP preview, okay, NDP preview show 2. And then it was the start of that avalanche, which resulted in the market since for the past 2.5 months, dropping close to 12%. As of last night, how many of you stayed up for the market last night? Anybody? Oh, you did? Wow. So how was your morning? I suppose your morning was like mine. When I woke up this morning, I slept at 4 last night. So when I woke up this morning, or rather I slept at this morning and I woke up this morning, I was like, oh, it's time to wake up. Okay, let's go. Okay, so that's one of the downside being a Singaporean trading the US market. But looking at this, right, yesterday the market dropped even further. It closed the day at -1+%, and which comes the question, right? Where do you think the market is going to be from now to the end of this year? So how many of you think that from where it is now, right now it's about 4120, 4130 on the S&P 500. Do you think that by December 31st, which is about 8 weeks from now, how many of you believe that we will be higher than we are today? Can I have a show of hands? Okay. Anybody think that we will be lower? Can I have a show of hands? Okay. So it's about 50-50. Anybody not sure? Okay. That's why you're here, right? Okay. So my personal view, right, is that I don't think as of now for the short term, because my focus on the US market has always been around, as in my duration of trades is always usually around 2 to 3 weeks. That's my duration of trade. I don't hold trades for like 1 year, 2 years. I don't do all that much of intraday trading, meaning I open in the same day, close the same day type of trades. I don't do that as much unless the volatility picks up. So bread and butter, what I do is that I will take advantage of the kind of swing movement, explosive movements on the market. So today, right, whatever I'll be sharing with you, I will also clarify the time frame which I intend that outlook or that forecast to be. All right, so that you don't think that, oh yeah, GC goes up, that means in the next 2 years must be up. No, I can't see that far. Okay, so as of 2023, right now, I think by the time we end, hopefully, I think we will be higher than where we are right now, because in the short term, all right, in the short term, the market is pretty extended to the downside. How many of you agree that the sell down yesterday was quite fierce? How many of you agree with that? Okay, good. So by the sell down yesterday, a drop of over 1%, how is the market breadth doing? Anybody tracking market breadth? Not many yet. Okay, yes, Mr. Okay, so when you track the market breadth, what is market breadth? The concept of market breadth, right, is like heart rates. All of us, right, we have got a range of heart rate where if we sit down, do nothing, if we are resting, that's called our resting heart rate. It's like a baseline. And then when we are running, when we are exercising vigorously, then we will hit the maximum heart rate. Yes, everyone following? So when it comes to the market, and if you apply the concept of market breadth, right, it works exactly like our heart rate. It's just like if the market is extended to the upside, your heart rate is already at 80-90% of your maximum heart rate. How much faster or how much further can you go? Just a little bit more? Do you all agree? Okay, so likewise, if you are seated down or lying down on your bed, your heart rate is at a resting heart rate percentage. Then how much lower can it be? Cannot go much lower. Any lower, then something is wrong, right? So as of yesterday, right, what happened is that the market breadth, for majority of the market, it stands around 15 to 20%. 15-20% of the stocks are above their 50 days moving average. So think about this. If only 15 to 20% of the stocks are above their 50 days moving average, how many percent are below? Can you all do a quick calculation for me? 80% are below. So if 80% of the stocks are already sold down, how much lower can the stock market goes? Is it a lot or is it just a little? Is it a lot or is it just a little? Just a little bit more. All right. So this is what I wanted to start today with. And earlier on this month, right, start of early October, this is in my my close group with my students. I think Mr. Hung is inside. So this is on the 4th of October. I think that it is right for a false breakdown at that point of time, 4th October. And then I say I will prepare for the breakout line for a long swing up. So in that sense, right, at that point of time, the market was here. And that was on 4th of October. And then I said I will prepare for a long swing up, but not beyond 4,400 first. That was exactly what I said on the 4th of October. And over here, this is kind of what happened now. So in that sense, I kept telling my students and I said, this one hang, this one is called hang. Because nobody can nail down the market 100% with consistency like that. But what the point here that I want to make is, what leads me to this conclusion are the factors that I'm going to share with you today as well. Okay, so what leads me to this conclusion is what I will share with you in the next 40 minutes or so. So are you excited to find out what are those? What are those factors? Yes or no? Don't sound too excited lately. Okay, so at a point of time, the market breadth was also beaten down, and then it was right for a bounce, and combining with technicals, that's why I come up with 4,400. And right now, the market as of the close yesterday, I think we are quite close to the 4,120 area. This line, this pink color line that you see over there, I think is much closer to that, which personally, this is my view, not representative of anybody else except my own. So whatever I want to share with you today, can I get you all to agree? It is for educational and informational point of view. Is that okay? Do you all agree? This is the most important thing. If you don't agree, then I cannot go on already. Okay, so over here, I think that from a price level point of view, right, the market is due for a basing somewhere around 4,100. Can everyone say 4,001? Yes, good. So 4,100 is where I think the market combined together with market breadth, it's where I think the market should find a small support or small base over there. If you're expecting the next bounce to happen. So again, like I said, my trading duration is like those couple of, 1 week, 2 weeks, 3 weeks kind of duration. I'm not looking to write the whole thing, but in fact, I'm looking to write this small leg up, or the small leg down, things like that. So whatever that I share, right, if let's say I have a bullish view, doesn't mean, please do not take it as, oh yeah, I'm going to buy here and then the market is going to end up there. I wish it was that easy. Every one of us would be very happy, right? So from here, when it bounces, right, I think we have a few resistance in play, which over here, I think 4,300, 4,350, that is the immediate resistance that we are facing. Is everyone following? Yes? Okay, good. So with this, okay, good. So where do we go from here? The key levels to note are the immediate support, which is 4,120. That's the key level that I'm looking at on the S&P 500. Then, as a resistance, I am looking at around, you can see this pink color arrow pointing here, right? This session, the bounce of this session, which is at the top of it is 4,360. The bottom of it is around 4,310. So if you take the middle, it's about 4,340, somewhere there. I think this session, which is of significance, I highlighted it because it was the high volume node. And I do think, and I do believe that in the next bounce, where yesterday it ended here, right? As it bounced up, we are bound to face some form of resistance somewhere in that area. So how does this piece of information translate to your action taking? Well, you think about this. How many of us have an overall long portfolio? Can I have a show of hands? It means overall you hold stocks, you are long on them, and you're hoping that the market will go up. Have a show of hands, please. Okay, minority. Anybody that is short on the market, overall short, okay, also have. So what we do, right, or what you can do, is that you take note of these key levels, and then at the various levels pertaining to your overall direction, you can take them into advisement and then take defensive action when the prices reaches those levels. Is this clear, everyone? Okay, so these numbers, right, are not there for you to buy 4D. Okay, 4340, 4120 is not for you to buy 4D later tonight, but instead it is for you to time in that sense to know that, okay, a turning point possibly is over there. Then what do I do with my portfolio? If I want to buy, if I want to bounce, I want to prey on the bounce on the market, then which are the levels to pick up or to watch for? And then if this bounce happened already, where am I going to take defensive action? By number one, shifting up the stops. Number two, taking partial profit or taking entire profit as well. So is this clear, everyone? Okay, good. Thank you. Now, what does the where does the next 12 months entail? Just now, Paul and Jonathan already brought up the next 12 months, right? I think there are two major headwinds that we are all looking at as traders and investors in the market globally, not just the US. Because if the US goes into a recession, goes into a bear market, then globally, the financial system is just going to pull back as well. All right. So the next 12 months, right, I'm looking at these two factors that are what I call the macro headwinds that are possibly causing some, negative pressure or downwards pressure on the overall market. The first one, it is the inverted yield curve. Can everyone say inverted yield curve? All right, very good. So they came out better than I expected because the last time I did this, can everyone say inverted yield curve? So that was better. So inverted yield curve, which is what Paul brought up just now. Right now, our yield, right, for short-term bonds in the US is a lot higher than the bonds that are longer term, like 10 years and 30 years, they yield lower than the shorter term bonds, which means, right, the market is predicting, or the market participants, right, they are projecting a recession moving forward in 2024. And this is not what Jerome Powell, the Federal Reserve Chairman, has said. Federal Reserve Chairman Jerome Powell, right, he said and he mentioned that we are likely to avert a recession, and it is likely to be like a soft landing. So that's what he says. But the market participants, right, based on how they project the long-term yield of the market, they are expecting further down the road the yield to drop because currently it's at quite a high level. Well, think about this. It is quite attractive, isn't it? If today you have got I would say a significant sum of money, you don't want to do anything about it. Let's just say in the vicinity of somewhere 5 to 10 million, for example. All you need to do, just park it into a 30 years bond, which yields you about 4.7%. With 10 million, you get 470,000 a year tax-free. That's 40,000 a month. And basically, you can do nothing for the rest of your life, right? So this is attractive in a sense. There is a pull factor to get into the yield market, to get into the bond market. So likewise, right, some of my friends, myself as well, how many of us, right, in the last 12 months, we have shifted some of our funds into fixed deposit, into treasury bills, into bonds, Singapore-based? How many of us have done that? Exactly. Previously, when it was at 0%, 0.5%, was it as attractive? Yes or no? Not so lah. But now, not bad. I put in fixed deposit at 3+%. So what does this have to do with the US or the stock market? Because if you think about this, money flow or the money supply that is available in the market, it is a finite resource. You can't just have, let's say, 1 trillion in circulation and then 2 trillion the next day. We can't do that. Of course, over time, we can increase, but it cannot just go from double, within a short period of time. So think about this. It's about allocation. It's just like our savings. Our savings, the amount that we have, we cannot just double it. Of course, I wish also, right? I just double it tomorrow. I triple it tomorrow. All of us. How many of us wish for that? Of course, guys. You all laugh at me. You know why? Not possible, right? Exactly. So same as the stock market, right? It's all about allocation. So it's just like today, the savings that you have, right? You can't just double it, but what you can do is you reallocate it. Maybe you take it from somewhere else and then you park it somewhere else. So maybe for most of us, right, Singaporean dream is to have a property or multiple properties, right? So I'll take from the cash, go and buy property, liquidate one property, go and buy 2 more property. That's what the agents want you to do, right? So what has it got to do with the stock market? Well, think about this. If the pull factor is towards fixed income instrument right now, and then what's the push factor on the stock market? Overall stock market is also not behaving, not performing all that well, right? Then where is the money going to go? Either people are going to likely stay on the sidelines or they will shift the money into the fixed income. Does it make sense or not? How many of you think that makes sense? Okay, good. Thank you. So with that said, right, these are the macro headwinds. And in terms of psychology, what is keeping investors or renewed money flow back into the market? And until we settle this, the market is unlikely to go into a bull run that we have experienced for 2020, 2021. And again, that's my view. All right. So is everyone following? So far, so good? Okay, great. Thank you. So since the rate went from 0.25% to 5.5%, right, it was actually quite marvel, quite impressive in a sense. We started the year last year at 0.25%, which everything's still okay, everyone's still partying, making merry, right? And then last year, if you are one of the unfortunate souls like me, where your mortgage fixed rate just so happened to, expire and you need to refinance it, how many of you are in the same shoe as me? Yes? Don't have? You're all very lucky. Because every month now, I suck out a huge chunk of the cash flow, all to service the interest. Okay? So the rates, right, increased tremendously, fastest ever, from 0.25% at the starting of the year, and then it just shot up to 5.5% to where it is right now, just in a span of 1.5 years. It just went, boom, just went up like that. And over here, how did the market reacted to it? So that's where, right, the technical aspect of reading the chart comes in. You will realize that by October, by the time October was there, right, the rates was a done deal already. The rates wasn't at 3%, 4%, it was at high 4%. So it was pretty much a done deal over there. And since the market is settled on 4.75, then you go to 5%, and right now it's 5.5, right? How did the market behave and reacted? The market reacted in a bullish manner. So what does this tell us about human behavior and pricing behavior? Humans always like to make understanding of the factors right now and make decision based on those factors. Is that true? Yes or no? Maybe not so true. So give you an example. If let's say, touch wood, if you got wood on the table, then you touch the wood first. If your current employment, your current company, you know that moving forward next year, your livelihood, your job may get affected, what would you do? What would you all do? Okay, if you're rich enough, right? Retire at home, shake leg already, right? So you all will go and look for a job, yes? And when will you look for a job? Only next year when it really gets served to you, or you will start looking for it now? Which one is it? Now. So humans are always forward looking, meaning whatever actions that you take now and you take today, you don't actually care that the interest rate is 5.5. What you care is that in 6 months down the road, given where prices is right now, 6 months down the road, where is the interest rate likely going to be? Do you all agree? Yes? Okay, so this is the reason why, right? If you look at the price movement, the price have tanked down, in the starting first half of the year. If you recall back what happened last year, the bottom of the market was actually sometime around June. The bulk of that drop, right, happens in the first half of the year, where the interest rate was still just rising slowly. But as it rose more ferociously, actually the market just bottomed out and going forward and just, V-shaped rebound from there. Why? Because at that point of time, that's where the factors become a lot more clear. That's where the market participants know that, oh, okay, so you're going to raise until there only. That's about it. So this is the first thing, right, that all of us should conclude when it comes to reading charts. It is all about expectation. It is not about reading now, using the information now. Where the chart is likely going to go or behave is based on what you think about this market 3 months down the road and 6 months down the road. Okay, so can everyone say the word expectation? Okay, thank you. Very good. So since the rate goes to, from where it is, 0.25 to 5.5, as you can see here, I superimpose the S&P 500 on top, and then at the bottom is the Fed fund rate. So over here, right, you can see this increase. And right now, we are at this very interesting juncture where the interest rate seems to have hit a top already at 5.5%. So moving forward, as Paul mentioned just now, the expectation for interest rate is that next year, they are unlikely to raise further, but instead they are looking to cut the rates. So that was what was being said. How many of you got the same conclusion? Yes? Okay, thank you. So what I'm going to do here, from a technical point of view, it's also to study and reference it to what has happened before, because where we are now, today, it is not new. It has happened before. So if you look at this, right, in 2019, this was what has happened before. During 2019, that was still during Donald Trump's presidency. The interest rate was increased, and finally it held plateau for a moment. And I want you to take note and observe two things. Number one, the price movement. Okay, I want you to take note of the price movement. Number two, the interest rate plateauing. So this was what happened in 2019. And right now, today, I will think that we are close to here. Okay, right now, today, I think we are close to the start of this plateauing. So if you go back further, right, 2019, we go back further, this is 2007. So 2007 was quite interesting. Back then, the Federal Reserve Chairman is Alan Greenspan. He raised interest rates 17 times in a row from 1.25% to 5.25%. And then after that, right, he kept the interest rate steady. And right now, we are there. So again, observe the same thing. If this was what happened in 2019, where the market behavior was this, the interest rate behavior is this. Looking at 2007, market behavior, interest rate behavior. And then we go one cycle back further. The next cycle back, right, is 2000, which I think is much closer to where we are now. So for 2000, this is where the market behavior was. So it is kind of flat for the whole time that it is plateauing. And then the interest rate will just plateau, just like that. And if you look at this, right, how long was that duration? The duration was from May 2000 to November 2000. How many months is that? 6 months or so. So just now that Paul mentioned this, right, I want you to reference it to the condition that we have today. Right now, we are in November. All right, we are in November where interest rate is, sorry, not November, I'm ahead of my time. October, all right? So right now we're in October, and when does the forecasted interest rate cut is, when is that forecast of that first cut? Is it the first half, the first quarter of next year, first half, or late next year? Which one? About sometime in the middle, then they'll start to cut, right? So you think about this, from now till let's say June. How many months we have? 6 to 8 months, right? So 6 to 8 months of plateauing is quite close to this. 6 to 8 months of plateauing is quite close to that of what we have in 2000. And if you look back, right, this one we had way longer. We had about 1 year plus. 2019, we have about close to 7, this is what? 2018 December, so it's about there. So 6 to 8 months. So over here, what I wanted to share with you, or the point of showing you these few slides, is this. If you look at the corresponding market action versus the interest rate action, right now where we are, okay, right now where we are, may not seem to be as bad as what you are feeling right now, because yesterday the market dropped 1+%. And then, right, there's a strong temptation if you're holding a long portfolio for you to do what? Don't I sell, cut loss already, cannot take it, cannot wait already, right or not? There's a strong temptation. And often, right, in your experience as a trader and investor, how many of us experienced this before? I'm sure I'm not the only one. You take a cut loss until, wow, wait, hold right at the bottom, I cannot take it already, and then I took a cut loss. And thereafter, shortly after that, right, the thing just reversed and went out. How many of you have experienced this? Yes. So welcome to the market. This is where you feel like taking a short, a short bias on the market right now, based on what you have seen for the past 2 weeks, rightly so. But here, if you combine it with the historical performance of where we are, where we were before, versus the market breadth, versus the technical aspect, you realize that if you want to take a short bias right now, your risk to reward is actually very negative. Okay, makes sense? Because right now it's very near the bottom and you want to sell, right? You want to sell low and hope that you can buy back lower. Then you need to make sure that there must be something bigger on the horizon that really can kick the market down, 30, 40%. But as of now, the question is, do we see any of these factors yet? That's the $1 million question. As of now, nothing is exploding or imploding as of now. All right. So this is 1998, the same thing. When the interest rate plateau, market behavior, and then what I'm afraid of, right, or what I'm more concerned with is what happens after the cuts. If you realize this, I go back a few slides, you will see that for 2019, when they cut the interest rate, when they start to cut, then of course the market goes up in a knee-jerk reaction. And this is 2019 heading into 2020. What was that? 2020, we had something that changed all our lives. What was that? COVID, it turned all of us into cavemen and cavewomen. We didn't need to cut hair for 2 months. I remember that. So when they cut rates, right, this is where I am, this is what I'm more concerned with, because historically, when the market starts or when the rates starts to unwind, it starts to reverse. Guess what? That's where, right, after when it starts to cut, all of us will know that 2007, what happens after that is subprime mortgage crisis. Then 2019, it was COVID. And then for 2000, it is the dot-com bubble. So every of the major correction or the major sell down, there has to be an external catalyst. So what it is for 2024, I don't know yet. All right. Maybe Paul will know it. So later I ask Paul. Okay. So 1998, same thing, Asian financial crisis. So what I want to say or what I want to bring attention to is that since now we are at this plateauing, so this is what I call the end game. How many of you watched this movie? Nobody. Well, I love Marvels. So this is where I just brought up this one for the sake of the title. So this is the end game, which means one more run, in my opinion. All right, this is my own opinion. What do I look out for? What do I mean by the end game? Well, if you look at how inverted this U curve is right now, the U curve has never been this inverted for the last 20 years until recently. You can see, okay, so let me explain what is this. This is the 10 years minus 2 years. So the 10 years bond minus 2 years in terms of the U, and the positive territory will mean that it is a normal U curve. That means the U curve is sloping upwards. All right. In the negative territory, it's where the U curve is known to be inverted. Okay, so positive, normal U curve, inverted is in the negative territory. So the U curve, right? So far, it is 100% predictor of oncoming recession. Again, the U curve, it is 100% predictor of oncoming recession, which is denoted by these gray boxes over here. So the gray boxes, the thickness of it, just how long that the economy was stuck in a recession. So over here, you can see negative territory, recession, negative territory again, recession, negative, recession, negative, recession, negative, recession. And then here, it was a very, very slight negative over there. If I were to zoom in, it's a very, very slight negative, recession. And then negative again, which is what we have been in for the last 1.5 years. Ever since last year till now, we are that negative. And right now, I'm watching closely to this because if you look closer to this right edge of the screen, you'll realize that it was so negative until recently it did a spike up and it literally went back up towards the neutral and heading into the positive. How many of you can see this? Yes? Okay, good. So what does this mean? Usually when the U curve is inverted, I am not that worried. But when the inversion starts to go back into flat, which is where it is heading to right now, heading into this neutral territory, right? When it was inverted, it goes into flat. That's where we are one step closer. Okay, we are one step closer to a more bearish market. So that is why I am looking out for this. Is everyone following? Yes? Okay, good. So I'm paying attention to this, and the moment it crosses up, right? Because if you look at the behavior of the U curve, Usually it's about 12 months before a major bear market, the yield curve starts to invert. And then the moment when it starts to come back, right, that's where it's like the peak of the peak. Okay, so that's again based on historical observation. So I am tracking this for sure. All right, I'm definitely tracking this, and we are one step closer. And the timeline, if you combine it together with the Federal Reserve trajectory of the interest rate, the timeline is around H1 of 2024 as well, because that's where they will start to cut the rates. All right, so far so good. Is everyone clear? Okay, good, thank you. Now, all right, good, thanks. So where are the opportunities? Well, this is where I did a deep dive, right? So why am I sharing this with you? Shouldn't I be, coming on and look at my charts and plot a few lines for you? Well, I think just jumping into technicals itself is not going to do you any justice. Step one of what traders, I find that what traders should do is to have a bias. Okay, can everyone say bias? Okay, so step one is to have a bias, meaning, do you want to go long or do you want to go short? And where do you want to be focused on? Which are the sectors or which are the stocks that you want to be focused on? So that's always my step one. And that's why I'm coming down to this. The analyzing, the getting into trade, that is step two and step three. That's the easy part. The heavyweight lifting, it's in the start. It's at the start. So if I were to break down the S&P 500 sectors, so we have total of 11 sectors. So if you exclude XLC, XLC is communication services. Previously, right, XLC counters comes from technology. It comes from technology, discretionary, and some others, all right. So then 2018, it came up with communication sector itself. So looking at this, right, there are a few sectors that are defensive in nature. Number one, consumer staples. Number two, healthcare. Number three, utilities. So these are the defensive sectors that we have on the US market. Energy, I put an asterisk over there. In a sense, right, energy, I wouldn't really consider them to be defensive, but they are sensitive. Okay, what do I mean by sensitive? Meaning it is more tied to the oil price and the crisis, that the geopolitical crisis around the world, rather than the state of the economy. Of course, the economy, the consumption, the demand, it does affect oil prices, and oil prices in fact, in turn, affect all your energy counters. But generally, the defensive sectors, right, are staples, healthcare, and utilities. And all the others, the rest, right, falls under cyclical. Meaning, what do I mean by cyclical? Meaning they will go hand in hand with the economy. If the economy picks up, they are likely to do better from a business point of view. If the economy slows down, then they are not likely to do so well. Therefore, cyclical. This is what they mean by cyclical. So why do I want to classify this market into two different teams? Because this is where, right, I did not that I did it, but this study did it. The Conference Board Leading Economy Index. So the data set is based on the data from them, and then, right, what they do is they take the last 60 years right up to just before COVID. Okay, this is November 30th, 2019. From December 1st, 1960. So it's about 60 years or so. In the last 60 years, in this 60 years period, we have 7 recessions, 7 recovery, 12 expansion, 11 slowdown. So over here, right, what happened was that, okay, this one a little bit smaller, but I zoom out the 2 sections that I want us to see. The first market cycle is, of course, a recession. Then it goes into a I can't even see what's that word, recovery, then an expansion, and then after a slowdown. Okay, the 4 stages of the economy itself. So over here, I have linked out 2 specific parts. Number 1 is the recession, which I don't think we are there yet, but it should be here sometime next year. And now we are somewhere around the slowdown period. How many of you agree? Can I have a show of hands that right now we are at number 4? Okay, good, thank you. So how did the sectors behave and perform in these respective periods? Well, if you take a look at it, right, during recession, number 1, consumer staples. The rest of the others are all posting negative returns. Consumer staples still quite robust when it hits into the recession. Number 2, slowdown. Where we are now, you can find that healthcare, consumer staples, utilities is also down, up there. Financials is like the 3rd rank. So in this period, this is where my focus is. So the bias right now is that, number one, I still think that we are at the end game. Okay, we are at the end game. So where should we focus or zoom in on? On the defensive areas. And looking at this, right, if I were to compare how the four sectors have behaved in the past crisis. So this is 2000, that is energy, this is utilities, this is healthcare, and that's consumer staples. So XLP is over here, healthcare and utilities. This is for 2000. You can see that for consumer staples, it is quite what, up or down? Still quite robust lah. Oh. Then for utilities, same thing, right? That's 2000. If we go back further, all right, if we go back further, where we are, why did I have this line here? This line, right, was when the interest rate starts to plateau, which is where we are right now, all right? This line is a reference point where the interest rate starts to plateau. So I want to draw on the past references. When the interest rate starts to plateau, how did these defensive sectors behave? And this was in 2000. 2006 was the same thing when interest rate plateau. You can see in this case, energy was quite okay. Healthcare was up. Obviously, consumer staples is quite robust. And then after that, utilities is robust. And then if you go back further, this is not further, you come nearer. This is 2019. So for 2019, you can see that while energy is like, meh, just going sideways, and healthcare still quite okay. But then again, this is excavated and buoyed by the COVID effect. All right, well, all the healthcare stocks literally just ran during that period. But if you look at staples, you look at utilities, you will realize that the trend is actually quite predictable and is quite dependable and quite robust. How many of you observed this across the last 4 cycles? How many of you observed this? Yes? Okay, good. Now, today, right, this is where we are now. This is where we are now, and the market is going into interest rate plateau as well. So what can we expect? Personally, my focus is heavier weighted on these defensive sectors. Okay, is everyone following? Okay, good. So now, after talking about this, we settled one thing. We settled one key thing, which is where the focus should be. Yes? So can everyone say focus? Okay, very good. So our focus, or at least my focus, is that I'm going to look at the defensive sectors. All right, I'm going to look at the defensive sector. Now, the next step would be the easier one, which is, then now I want to plot my lines already. So you see, plotting the lines, right? I give you an analogy. It's like digging for gold, right? Some of us, right? Of course, I don't think any of us have the experience of digging for gold. But if you look at National Geographic enough, right, they every time have those documentary about all those people looking for gold, sifting out, finding gold, and then they struck it rich, and then they go, yeah, you know, that's what they do, right? So, sorry, what has it got to do with us? Well, think about this. If you want to dig out the gold, you want to have the best equipment. Do you all agree? That means you want to have all the equipment at your disposal. You don't just want to dig with your bare hands and hopefully you struck gold. You want to have the equipments, be it a machinery, be it a tool. That's what you want to have, yes? So that's the role of technical analysis, because that's a tool. But what is more important? Having the equipment to dig out the gold, or knowing where the gold is in the first place. Which one is more important? Knowing, how many of you agree that knowing where the gold is more important? How many of you agree? Exactly. So that's why, right, I started today's sharing with where it is first. Where is it going to be? Where is my focus going to be first? Because if you just want to apply technical analysis, that's easy. You can just apply to any random stock, to Singapore stocks, to Hong Kong stocks. But is it going to give you the good results that you want, that you are looking for? The answer is, maybe not. So now that we have settled the first part, okay, my focus is over here. Now, what is the second part? The second part is, well, taking actions based on what we think. So now today, I want to share with you one way of how I do my analysis and formulate my trade plan. Is that okay to share that with every one of you? Is that okay? How many of you want this? I go home already. How many of you want this? Okay, good, thank you. So, performing technical analysis, now today I want to share with you how I use this one tool that helps me a lot in framing up the trade. And this tool is called trend lines. Can everyone say trend lines? Okay, so trend lines, forget about everything you think you may know about trend line. Okay, empty the cup. So can everyone empty the cup together with me? Is it okay? Okay, good. So trend line, I want you to know this. Trend line only tell you two things. It is not about the lines, right? They only tell you two things. Number one, the trend line shows you the speed of the price increase or decrease. So can everyone say speed? Okay, so that's what trend line tells me, the speed. So how do I measure this speed? It comes via the angle. Can everyone say angle? You all don't have angle. Okay, angle. Can you all do better? Okay, very good. So what I'm looking at, right, is the trend angle. This is what makes trend line so special. It is not about plotting one line up, one line down, then you have crisscrossing line, then it becomes like an X-Men. That's not the way. So what I want to pay attention to is the angle, because the angle tells me a few important factors. Number one, the angle will tell me when an unsustainable trend is forming. So look at this. You can't see this small number over there, but I'll just narrate it to you. This is 13. So this degree over here is 13 degrees, 13. Then on this steeple line over here, you can see that it goes from 13 to 27. So how many times in terms of multiples it is? Can you all do a quick math for me? Double, 2 times. 13 times 2 is about 26. So this is 27 degrees. So it doubles again. And usually when it doubles, right, it doesn't mean it's the end game. What it does is if it doubles and then it doubles again, that's where I would say the trend is unsustainable. Because you look at the last part of this, if you all can see this number, right, this number is about 60. Okay, 60, 62. So think about this. 27 to 60. How many times roughly? How many times is that? About double again. So how do you tell an unsustainable trend? Number one, if you have first a trend angle, and then it doubles, and then it doubles again, it doesn't mean that you go, whada, whada. It doesn't mean this. What it means is, I better be careful. Why? Because if it doubles and doubles, while you are making a lot of money, congratulations, do remember to keep the money. Because if you don't keep it, before you know it, where it goes. Okay, is everyone following? Good. So I make use of the trend angle to, number one, help me identify an unsustainable trend, to know when does the trend tends to be, like, if it's like ending a parabolic already. So you can quantify it using trend angle. And most of the traders that I observe, they draw their trend line in this sort of manner. How many of you uses trend line and your charts looks like this? Can I have a show of hands? Don't have. Oh, I say really don't share. Okay, so what I realize is that traders tend to have one line here, one line here, one line here, then they just link the two top, they link the bottom to the bottom, they link this bottom to that bottom, and then they come up with varying degrees, and then they come up with a what? One big question mark. So what does the line tell me? Oh, the line tells me that you are doing homework, very good. But does it conclude to anything? The idea, the thing is, it doesn't. So for me, when it comes to technical analysis, it is not about drawing a lot of lines. It's not about drawing horizontal line, not drawing diagonal lines. The lines, if you cannot make any message or conclusion out of those lines, the lines are what? Useless lah, right or not? You draw so many, then, if you fill this chart with enough lines, right? You can have a horizontal line, a vertical line, a diagonal line, then you add on Fibonacci, you add on arc, you add on whatever, right? Then your whole chart will look so pro until if you ask the $1 million question, so where is the chart turning? When is the price going to turn? I don't know leh. Right or not? So the point here is not to draw lines like this. Let me share with you my way of drawing trend line. Well, this is my approach of drawing trend line. Number one, okay, it is to find the accepted angle of attack. Can everyone say accepted angle? Now, let me explain what it means. accepted angle, you can see that on my line over here, I have a solid line right at the top. Then I have the dotted lines in the middle. What do they mean? I have a personal, habit of using a solid line for the first line that I draw. Because the first line that I draw, what I mean by accepted angle is that I first want to see this chart, right? Okay, or this line, they must link up with a few other turning points already. Okay, that means if I were to zoom out later using more examples, if I were to zoom out, you can see that this chart or this first line over here are linked up with a few points. That's the first thing that I do. So the first thing you have to assume or try out, which is the accepted angle. So it is a trial and error. So first thing, you link up the top, and then that's the first part. The second part, okay, the second part is that you need to clone the same angle. You realize that all my lines are parallel to each other. How many of you realize this? Yes? So my lines are parallel to each other, and what I do is I don't change the angle. I fix the angle. And why angle is important is because it comes from this mathematical concept called regression. Right? I learned that in JC. I forgot all about it already until it came out here. So it's a distribution of the data within this period. And that the concept is called regression. And by doing that, right, I take the angle, I replicate this angle, and I try to find other turning points and see whether, first one is my assumption. Second one, I will see, has the market reacted to this assumption? So step one, assume. Step two, verify. So what is step one, everyone? Assume. And step two is verify. So how do you verify it? Step one is up there. So step two, right, as you can see, I cloned the same line downwards. That's why I make the distinction between a solid line and a dotted line. So I know that the dotted lines are those that clone, all right? And you realize that over here, you will see that the same angle, the prices will react. It will react, kind of react before it, it tank down, and then after that it react from a support zone. It now becomes a resistance zone. And then when it comes back down, from where it was here, that was in 2021, until here in 2023, almost 1.5 years later. Do you realize that the same angle still is in contention? It still comes into the view, right, that it affects the market movement in that sense. So whatever was a support over there now become a resistance area. And when it got up to the same trending down angle, the same angle, it got rejected again. And then finally, it broke above earlier this year. Finally, it broke above, and then it has to, consolidate around the area before it jumps all the way up. So with these, right, I also want to test out, okay, not just these few points. Do I have more examples of verifying that this is the level or this is the angle that the market participants are looking at as well? So over here, you can see that there was a support, in this thin background of it. There's a support area, then it bounced up, then again here, resisted, bounced up, supported, and before it goes. So the more points that reacts to this angle means what? It means that this line is not something you just snap your finger and come up with. This angle is something that the market participants are also looking at. Because to traders, right, it's not just about patterns. You realize I don't talk about head and shoulders, Harami, I don't talk about any of those. Those are, I think, very good articles to write online and then get readership from there. So for me, I don't use any of that. I rely, number one, back on, you can see my whole chain of thought, right, is know where to focus on. And then, right, after knowing where to focus on, rely on tools like this, which are, bread and butter, evergreen, and you can apply to any stocks, and look for, in the grand scheme of things, where is the price action now? And then third step is to form, a scenario of where would it make sense for me to get in, where would it make sense for me to get out, based on the lines that I have over here. So again, I'll show you more examples, I think, to better help to better concrete your understanding. So first thing, it is to assume. Second step, it is to verify. So can I make sure that every one of us are on the same page? First step is assume. Second step is verify. So you verify using the same angle clone onto other swing points and see what was the previous, what is the behavior so far. So looking at this, one key point to note, number one, there must be trend. Okay, number one, there must be trend. So if you're applying this to the Singapore market and the Singapore counters, I think it will be a little bit painful because it only goes sideways, yes. So first must have trend, as trend line suggests, right? You must have trend. Second thing is the trend cannot be parabolic, because if the trend goes suddenly parabolic like this is not typical of US stocks. This is not typical of Singapore stocks. What kind of stocks goes like that? Malaysia stocks likes to do this. It will just go sideways for a very, very long time. And then before you know it, boom, it just fly up already. And if you're in, you're in. You're not in, then too bad. All right. So if the trend, if the chart is jumpy, it's not fluent, or if the trend is like parabolic like this, in this case, this is a Bitcoin chart. All right. So if it goes parabolic like this, there is no much point for you to use the trend line analysis that I have shared, because basically it's just one line up only. So you can't have any meaningful analysis based on that. Okay, everyone following? Yes? Okay, good. So now let me apply it to S&P 500. This is the S&P 500 chart since late 2021. So from late 2021 onwards, right, for 2022, we were in a bear market briefly. So the market tanked 20, slightly 20-ish%. So we were in a bear market, and this year, it actually rallied up quite a fair bit. So over here, right, you realize that this was my so-called control line. This is my assumption line. My first step, assume. So my control line is up there, and I link up the top previously of 2022, and then now linking it to the top in, when is this? This is August of 2023. So with the control line, I use the same angle, I replicate it downwards. You realize that. Do you all see the reaction? Yes? So a support, same angle, supported, not just one time, again, and again, and again, and now become a resistance again, and again, and again, before it goes upwards. So what is the implication of this line over there? What is the implication? Well, think about where the market is now. The market is dropping as we are speaking. It's at 4120, somewhere there. Then if this same line trending downwards, where is it pointing to? It is pointing to somewhere around 4,000. So from a technical standpoint, where do you think, or where do I think the next base will be? Naturally, because it has happened again and again before, I will think that it is somewhere around this area. So is everyone following? Yes? Okay, very good. So if it comes to that, that's where I know that, okay, if the possible turning point is over here, then what am I going to do? If I want to long, do I want to long it like now? No, the timing not there, the price is not there. But it will make more sense for you if you want to long somewhere closer to the bottom, that area. Make sense or not? Everyone okay? So this is S&P 500. Now on XLP, all right, for XLP, this is where XLP is one of the defensive sector. I am personally in some of the stocks within SLP. I mean Walmart. So WMT is doing quite well. So over here, right, you realize the same analysis, okay, the same methodology. This is my control line. So this control line is a lot clearer. The control line, you can see that it touches the top again. 1, 2, 3, 4, then 5, then 6. So many instances. And in this case, quite nicely, right? It links up all the top quite nicely. Right? How many of you think so? Yes? Okay. So with these, right, you see, it links up so nicely. And then I use the control line, the assumption, and then I'll plot it to other swing points. So in this case, right, I saw that, okay, the resistance is the most clearer. It's the most clear one over there. Take the same angle, transpose it downwards, resistance, and then, not bad, see some form of support, cut through some form of support, and then support before it crashes through. And with the same angle, if I superimpose it to the bottom from 2021, that was in June, this is in August, it transposed it. It found the bottom of October last year. It almost find the bottom for this year. So what is this? This is not magic. I also don't know why it works. But for me, the job as a trader is to know that, okay, if this pattern works and it repeats, then my focus is on the how do I make use of this? Okay, is everyone clear? Let's focus on the how. Can everyone say how? Exactly, not the why. The why is because it's just regression, right? So if I were to pull out a line, one more line that tips this bottom, and I swear when I did this, right, when I plot out this line right at the bottom, and then the beauty of it is that this exact bottom right at the tip, and it transposes out to right at the bottom. So what does this tell me? This tells me that it's not just me, but overall market participants are also looking at this angle itself. So using this as an example, all right, using this as an example, if I want to frame up a trade, then at least this tells me that from where it is now to the upside, how much more do I have? So from where it is now is about 68. Yesterday, it dropped down to about 66 something. And I know that moving forward, the upside should be around 75, 76, somewhere there, because I'm not counting on it to break above this, because for the past 1.5 years, it has never done so. Does it make sense, everyone? Yes? Okay, good. So for healthcare, it's the same thing. This looks almost horizontal, but it has a slight angle to it. Almost horizontal. We can see that healthcare is still dropping as of yesterday. Yes, it's still dropping. So if you want to pick out healthcare, you want to pick up healthcare, right? Don't pick the falling knife in the middle of nowhere. Wait for a point. And this is what the lines do for me. It tells me which is the point, what is the price that I'm supposed to keep a lookout for. Okay, so these are not like magical, well, I touch there, I buy lines. What this is that, okay, it touches there, it tells me that now I'm nearer to the bottom than it is the top. So where does that leave me with my risk to reward? In a much better risk to reward, right? Because your risk, if you are buying near where previously was supported, your risk can be just quite small. And your reward from here to where it was to the upside, your reward can be tremendous. So if you are looking for those positive risk to reward, 3:1, 5:1, they don't come often. But when they do, these are the tools that you can use to help you pick up those trades. So is everyone clear? So far, okay? So far, is it good? Is it enjoyable? Okay, very good. Now, last application for the defensive sector. This is utilities. So utilities is in a major downtrend. As for 2022, you can see it's just trending downwards. So utilities have some of the very strong stocks within. Next Era Energy, Southern, Dominion, all these are the big companies within utilities. And if you were to look at utilities, right, you can see that as of late, they have already bounced up a little bit already, not right at the bottom. And this angle, the control line touches the top, the top, the top, the top again. The control line, if I look at the bottom, right, it links up the bottom, the bottom, the bottom, and the bottom. So using this as an idea, if I want to get in on utilities, right, I would be thinking of where is my targeted price that I want to get in at. And then once after I've gotten in, where do I want to take defensive action, which includes taking partial profit, includes shifting up your stop loss, or closing out the position altogether. That is what I mean by defending. So what these lines does, right, it's like driving down a highway. When you're driving down a highway, like how I get to here, the Raffles Town Club today, I came through a highway and it doesn't directly exit and leads me to Raffles Town Club. I have to exit at the nearest exit, right? So the nearest exit for me was at Adam. So I exited and then I turned down. So what these lines does, right, is that every of the touch point over here, I would like you to think of them as highway exit. You can't just get your car off the expressway by ramping through the barriers. You can't do that unless you want to appear on Stormline. So what you can do is you will just exit at the nearest one to you, to your destination, yes? And these are what the lines tells me. These are the highway entrances and these are the highway exits. So if I want to enter, I want to exit, those are the levels that I want to take note of. So is everyone clear? Okay, good. Now, so the trade plan, right? is mostly to using XLP as an example, right? The trade plan is roughly, the entry as of yesterday is about 66 something, 67. So if I'm looking at entry, what I'm thinking about here, I'm not saying buy here, okay? Don't get me wrong, I'm not saying buy here. What I'm just saying is that if you buy around this area, if your entry is around 67, 68, your stop loss, it's going to be tighter. Your stop loss is going to be tighter, which where the price is allows you to do that. And should it realize the potential moving forward and hits up slowly over to let's say the 75 area, guess what? Your risk is very small. Your reward is actually quite sweet. How many of you can start to see this now? Yes? Exactly. So after my session, you go and pull on the chart of UNH. Okay, later you go and look at UNH, you will realize that for UNH, my buying price is below 470. You can go and take a look at it. Today, it's 540. Same idea, same evergreen concept, and same application. To me, it's all about risk to reward. So can everyone say risk to reward? Exactly. That is what keeps you sustaining and profitable in the long run. It is not about secret methodologies. It's not about chart patterns. For me personally, I don't use that. I use things like this: risk to reward, control my position sizing, have an idea of where the goal is, focus on that, and that's what I do. All right. So it may be slightly different from what you are what you have been experiencing, what you've been exposed to so far, because a lot of the talks, they just straight away jump into I draw line, I use technical indicator, I use RSI, CCI, MACD or whatever. For me, is you realize my chart, I got none of this. And it works for me lah. All right. So take that into advisement. And with this, right, I want to leave you with 3 stocks. Okay, I'll leave you with 3 stocks. I know just now you have a lot of stocks already. I have my own stock that I'm focusing on, which you can try applying to this concept. So you may want to take out your phone first. So as I screen through them, then I will jump away, So I'll give you some time to take photo if you want. But again, before I share with you those counters, please agree to one thing. They are for education and information point of view. Is that okay? Is that agreeable? They are not to be construed as buy or sell recommendations. Please consult a professional over here if you want to buy or sell and you have no idea. All right. So I'm looking at this. Number 1, Walmart. I'm already in it personally. Why I bring this up is because the S&P outperformance, right, during recession period, which is 2020, it outperforms S&P by 5.1%. Then for 2008, it outperforms S&P by 56.3%, which I think is quite robust, considering that now where we are, heading into where we are going to head into. All right. So this is the first one, Walmart. Everybody took photo already? Yes? Okay, good. Next one is Synopsys. So Synopsys, right, is a technological, I would say software company that allows all the chip makers to test out their chips, their semiconductors. All right. So they provide a platform which engineer can design, test semiconductor chips and other software applications. And if you look at this stock, right, the ticker symbol is SNPS. This is one very, very strong stock since the IPO in 1998. If you zoom out the chart based on monthly, you go and look at since 1998 to where it is now. Look at where the prices was before and look at where the prices is now. Now it's 400 plus. Last time it's just double digit only, low double digit. All right. And this withstood the COVID. This withstood, of course, 2008 during subprime mortgage crisis as well. Outperformance COVID 70%. Of course, this is excavated by external factors. If you all recall, right, 2020, 2021, there was a shortage of chips across the industry. All right. So this, of course, excavated by external factors. But go one time back in 2008, you realize that it still outperforms by 9.9%. So Synopsys, this is the second one. Everyone took photo? Okay, good. And the last one is this. Okay, this seems a little this seems a little weird. How come I will look at stocks like this? Okay, it's because if you look at Walt Disney, right, it outperforms in 2009%. That was largely due to Disney Plus. Okay, that was largely due to Disney Plus. In 2008, it is 8.8%. And right now, I am bringing this up because, number one, Disney, FYI, I think Isang was laughing because he knows about my history with this counter. Disney was the stock that gave me my first pot of gold. Back then in 2011, when I started to do this, Disney was only $20 over. So Disney, every year, from a time cycle point of view, okay, it will tend to rally from late October for the next 7 months, all the way until April, May, somewhere around there. Of course, on the time cycle analysis, it doesn't mean that it will rally this year, because it's just a probability. Past performance does not equate to future, or rather past results does not equate to future performance. But at least I know that now, timing for Disney, we are around there. We are in this period. We are not in an election year. Next year is an election year. And Disney, if you look at the price right now, it tends to just drop below the bottom or near where the COVID bottom is already, if you go and look at the chart from a chart point of view. So from a chart point of view, right, if you apply the same analysis, the risk to reward for Disney, if you apply it, what I shared with you just now, apply it to Disney, you realize that the risk to reward is actually quite favorable in your way. So for me as a trader, I'm always looking for trades that gives me a good risk to reward. And I cannot stress that enough. It is not about tips. It's not about some secret methodologies. The methodologies are open. It's just about when you apply and when you decide to get in, you have to carefully evaluate what's your risk and what's your reward. Okay, so far all good, everyone? Okay, great. So did you enjoy yourself? Yes. So I feel more like an MC, right? I can take over your job. Okay, so to end things off, these are the ticker symbol or the stocks within this. You can Google this information. This is Staples. Okay, these are stocks under Staples. Procter & Gamble, Costco, Walmart, PepsiCo. These are the stocks that I'm looking at from now, moving forward. And utilities, I have NextEra Energy, Southern, Duke Energy, Sempra, etc., etc. So this is from utilities. This is from Staples, in addition to the 3 stocks that I shared with you just now. All right. So, yeah, thank you. All is good. Thank you so much. Thank you.
So stay tuned, because Jay and I will come back with a full orchestra and we're going to sing Frank Sinatra. How does that sound? Sound good? No? Okay. Joke fell. Thank you, Paul, Jonathan, and Jay. Now let's move on to the Q&A section. I believe that we all added our questions onto the online portal, slido.com. And if you did not, we will be taking in some of your questions in person too. So we'll start with the most upvoted questions. Let's get that open. And let's get our speakers a microphone, or I'll give you this one. I guess I'll read out the question. Bear with us. Oh, good. Okay, yeah, you can sit there. Yeah, that's a good idea. Okay, first off, based on recent results announcement, is Alphabet losing cloud market share to AWS and Azure? John?
Yeah, so I'll take this one. So essentially, the short answer is yes. I mean, just look at it from an absolute revenue perspective. I think cloud was about 8 billion, whereas when you look at AWS and Azure, the 25 billion. So the short answer is yes. The long answer is they don't actually, I guess their target market is a little bit different. When you look at AWS and Azure, they're more on the, I guess, large scale infrastructure as a service as well as platform as a service. So the kind of customers that they target is a little bit different. Like, just for example, I guess when you look at all your Netflix shows, right, all the streaming shows, they're mostly hosted on AWS, either AWS and Azure, whereas you will never find it on Google Cloud. So when you look at why Alphabet is losing market share, first of all, is because they don't actually have a big pie compared to the other two in the first place. Second of all, their focus on customers is a little bit different, so they're more focused on I guess cloud as a service, and that's more like I want to say customers that are using their productivity tools like your Google Sheets, your Google Workspace. So I think that's generally where their focus is compared to the other two. And that being said, obviously most of the volume comes from your large enterprises that want your cloud as an infrastructure as a service, and that's kind of reasons why if you look at the whole cloud market, AWS and Azure are kind of growing and pulling away from Alphabet, Google Cloud. Yeah, hope that answers your question. Thank you.
Okay, great. Next up is UOB below book value now. Is the current dividend of 1.7 Singapore dollars per year sustainable?
So the challenge now for the Singapore banks is the handover from record net interest income. When rates fall, obviously the net interest income will kind of taper down. So it's the handover. So what is the handover? So the handover is when interest rates come down, number one, can you get better loans growth? Can you get better fee income, wealth management as the markets, at least the equity markets, a bit calmer, then you can sell. So we think it's sustainable because there will be that handover. And the third point is that if rates do come down, it also makes that 6% a bit more attractive relative to bonds and relative to that. So there are some offsets. So it's not that when interest rates come down, the whole income for banks will just completely collapse. So there is a handover from that. But just that we think structurally, the earnings, I hate to say this, but they actually under-earned during the early years when rates are very low. Because the way the model is here is that we have a lot of excess deposits and high interest rates. It's like a freebie for them. It just goes straight to the bottom line.
Fantastic. Let's move on. From a technical perspective, around 4,100, as the trader mentioned, is a good level to enter the SM. Oh, sorry. Do local banks have any overhang of unrealized losses on their balance sheet from holding U.S. treasuries that have market-to-market losses like their U.S. counterpart?
Yeah. So if you take SVB, the very extreme of a bank balance sheet in the US, I think roughly the number, probably 80% of the book was in treasuries. For typical Singapore bank is the flip side. 20% of the book is in treasuries. So there are unrealized losses, but because the size isn't much, so it doesn't get reflected in the earnings. You don't see in the earnings. So just to give you an example, if you take UOB Bank's results recently, although they made 1.4 billion, you'll notice the book value didn't move. Of course, partly because they actually paid that out in dividends because of the timing, but it still fell about 400 million. So we think half of that, it could be book value losses, but you just don't see it. So now that you already had like 500 basis points of rate hikes, most of this already been flushed out. So then you come to the flip side of it. If rates do come down, they will get the gains. And the bigger winner should be OCBC because of the insurance arm. The mark-to-market gains that the bank enjoys will be pushed up to the top line, to the P&L, but more than if you compare to the other banks. But so just to answer the question, I don't think there's an overhang because I mean rates kind of peaked and most of it is already taken out. They call it fair value to OCI or to the equity rather than the P&L. So it's already reflected.
All right, fantastic. Thank you. Let's move on. From a technical perspective, around 4,100, as the trader mentioned, is a good level to enter the S&P 500. What is a good take profit level?
The good take profit level or the defensive level based on the chart that I showed just now is around 4,350 thereabouts. And I think that the overall head resistance of 4,400 is still in play based on the charts that I've shown on screen just now. So if you want to take defensive action and take profit, I think that would be a nice area for us to consider over there. Yeah.
Great. Okay, let's move on. Do you think next AAPL's earning results may cause the Magnificent Seven to finally tumble back down for the year? Now is bad for Google, Meta, and okay for Amazon and Microsoft.
Yeah, so that's a good question. So I think for Apple, first of all, the earnings expectations is not that great. I think revenue is expected to contract or be around flat. Whereas when you compare it to the other big tech guys, revenue was expected to grow maybe mid to high single digits or even in the teens. So the expectation is already quite low for Apple. I think what's happening in the market right now, especially over the last 2 weeks, is that the market's not really rewarding good results. I mean, you just take, for example, like Meta, right? Their earnings grew 2.5 times, but stock didn't really do much. Same thing for Google. So they're really punishing a lot of the, I guess, more negative news, or rather less positive news. But on the flip side, when you look at Apple, I think when expectations are a little bit lower, unless the company really does very poorly, I don't think there'll be much negative reaction to it. When it comes to bringing down the rest of the Magnificent Seven, yes, it has a big weighting because it's the largest cap stock there. But I think just purely based on market expectations, because it's not already that great, unless it has a very poor earnings results, it shouldn't really move much. Yeah, that's just my opinion on it. I think it's very difficult to predict how things go. Sometimes when you think the market's going to react positively, it just really doesn't, and vice versa. Yeah, so that's just my take on Apple's upcoming earnings next week. Thanks.
All right, thank you. Let's move on. Capital Land Ascot is part of the Absolute 10. Do you think there will be an earnings beat when they announce results on October 30th? Hospitality still has legs to run.
So for Catalan Ascot, I think the first half, the dividends grew by 30-40%. We still think there's momentum, mainly because what we are seeing, at least in Singapore and globally, is the Chinese tourists. Just to give you some flavor, I think a year ago, probably arrivals in Singapore about 10,000. We're probably hitting like 200,000 now. So this is not, of course, not a unique phenomenon to an expensive country like Singapore. So it's across the board. So we think there's still momentum to it in the next, probably up to the first half of next year. But of course, we were not naive. Leisure is a discretionary spend. So if there is a slowdown, hospitality is not immune. So that's one point. And the second point is that there is a bit of overhang of CapitaLand Ascott because they did I can't say unsuccessful, but less successful placement. And probably some of the underwriters were stuck with the shares at 102. So there's a bit of overhang on that stock. But operationally, I think the momentum for hospitality in general probably could run until the first half of next year.
All right, thank you. What is your view on Chinese tech, Alibaba, Baidu, and Tencent?
Yeah, so I guess we have to caveat that we don't really cover a lot of these Chinese companies, but just off the top of my head, valuations for all of these Chinese tech companies are actually very attractive right now. The biggest overhang would be just the Chinese government in general. I think that's the biggest risk. Like a lot of investors aren't sure, how. I guess, or rather, the CCP is a bit unpredictable when it comes to a lot of their policies, and so I think that's reflected in a lot of the pricing for some of these tech companies. But if you just look at the financials alone, financials have actually improved. The fundamentals have actually improved quite significantly over the last 6 months. So if you just imagine if these companies were in the US, they probably would be doing a lot better. I mean, or rather, if they were US companies, they probably would be doing a lot better than how some of these companies are actually performing. Just because they are Chinese companies, a lot of investors in the US or people that invest in US markets they're not very comfortable with some of the policies and some of the changes that are going on in China. Yeah, so that's my take on some of these Chinese companies.
Okay, great. Thank you. Jay, I believe this question is for you. How will your view of the market movement be adjusted if the current war in the Middle East escalates?
Traditionally, if you look at the geopolitical situations that are developed before the war, if you reference it just to last year, right? you look at how the Russia-Ukraine war develops, for me, it's about what are the key sectors that will be affected. Number one is definitely the defense companies. So if it becomes a prolonged war that if the other, the other nations need to partake in, then of course, yes, it's going to create further volatility in the market. But as of now, the market reaction is not so much pertaining to the war that is ongoing in, between the Israel and Hamas. So the reaction wise is not, it's not as serious as it was compared to last year's Russia versus Ukraine. And that's one on the overall market. If you look at the oil prices didn't actually spike all that much as compared to how it did last year when the war first broke out between Russia and Ukraine last year. So I would say that this is I wouldn't say that it's a non-event, but it is not just, it's not weighted as seriously towards, the overall market right now. So if it escalates, then yes, I do not know what is going to happen. What I will fall back on are the levels and of course the reaction to those levels that is based on technical analysis. I'll look at those levels and the reaction versus those levels. Then that would help me determine what is the next course of action through the risk to reward point of view. What should I be doing? How should I be taking? Should I be defensive, etc.? Yeah, so hope that answers this question.
Okay, wonderful. Let's move on. Is the US government likely going to continue with the higher than normal treasury spending as observed in Q3 of 2023? How will this trend affect the US equity market?
Okay, maybe I spoke so fast, I can't remember. The one key point, so I need to go, we think the fiscal deficit would narrow. One thing I forgot to mention, because again, I spoke too fast, was because there's a bit of quirk right now in the deficit, because California deferred their taxes from October to now November. It's just that very hard to get a handle of the numbers, but you're talking probably 200-300 billion of revenue that's not in the government's coffers. So this could be a drag to the whole fiscal deficit. So we think the deficit will come off, and it will of course also slow down the US economy. Why the deficit? So the deficit benefits the equity market in the first phase because you get earnings growth, you get momentum. But the flip side of it is that you get higher interest rates, which has not happened until right now, that it started to affect the US market. So the key metric that we monitor every month is just government deficit. But I mean, just to answer it, we think it will come down because of the earlier things that I mentioned in the slides, but also this very lumpy collection in California, which we can't nail down the number, but we think maybe 200-300 billion. It will start to kick in middle of November. So first quarter of 24 is maybe you could see the real impact of a slowdown in the US.
Okay, well, let's wrap up the Q&A section. Let's give a round of applause to our speakers. Thank you very much. For that last question, will the slides be shared after the session? Yes, for the session just now, we will be uploading the recording on PhillipCapital's Facebook page and YouTube channel. You may view the recording of the webinar on your own time. All right, so that's the end of the Q&A section. Thanks again to our speakers for the presentation and interactive Q&A. Once again, thank you all for joining us, and we hope to see you again at our future events. Stay tuned, take care, and have a nice day. For everybody who's joined us in person today, thank you for coming. We do have a buffet lunch prepared just for you. So I believe it's inside the ballroom area. You can also speak to our peer investors, the speakers. Thank you so much. Enjoy the lunch. Have a nice day.